Accounting, accruals, matching concept. Accruals, any expense that is accrued or been incurred but not paid for, and any incomes that have accrued but not yet received by the business should be recorded in the year or accounting period they accrued. Matching, expenses and incomes relating to the same accounting period should be matched. Therefore, prepayments of any expense or income should be deducted from the expense or income item in question, since they are not for the accounting period in question. Prepayments mean prepaid, paid in advance, overpaid, paid more than was enough, etc. Accruals of any expense or income should be added to the expense or income item in question, since they are for the accounting period in question. Accruals mean accrued, accrue, not yet paid, amounts due, outstanding, paid less than was required, etc. Let's demonstrate the accruals matching concept. So we are given a question there. It says, at the end of a business financial year, the following amounts had been paid for each of these expenses. And then you're given a list of expenses there, pretty much like a list or a trial balance that you should expect to be given when you are preparing any income statement and a statement of financial position in an exam. And they say, you are given the following additional information. What are they expecting you to do to calculate the amounts to be charged to the income statement at the end of that particular accounting year? We now need to apply the accruals matching concept. So the solution for the amounts to be shown in the income statement, you find that under the administration expenses, we were given 3,420 as on the list or the trial balance as the amounts that were paid. And that was 3,420. We are told that administration, under the additional information, that 270 of the expenses was due, yet it was not paid for. So we will end up writing 3,420 plus the $270 that had accrued but were not paid for. We should get 3,690. And this is the amount that's going to be written as an administration expense under operating expenses in the income statement. We should also then remember that when we are preparing this statement of financial position, this $270 that has accrued for the administration expense is going to be written under current liabilities because we still owe for that particular expense. Moving on to the insurance, we are told that insurance of 1,812 were paid, yet this included $124 paid for the following year. So this particular figure is going to be subtracted. Remember, we are matching the expenses for the same accounting period with the incomes and revenues for that same accounting period. So you get 1,688 as the expense to be written under operating or trading expenses. We move on to the interest on bank loan. We need to remember under insurance that the $124 prepaid means that we've overpaid an expense and those individuals now owe us money, which means this is a current asset of $124 since it's a prepayment, right? The bank loan that was interest there that was paid was $740. While $50 remained due, we should add it, which then gives us $790 as an expense to be included under the trading or operating expenses. Moving on, we need to understand that the $50 is going to be written as a current liability in the statement of financial position. The rentals of $9,440 included a payment of $620 for the following year. That is going to be subtracted because it doesn't belong to this accounting period. And according to the matching accruals concept, we subtract prepayments and we add accruals of expense or income items to the expense or income item in question. So we get 8,820. And as we can see, these are the figures that are then supposed to be included in the income statement. And likewise, the $620 for the rent that was overpaid should also then be included under current assets. Second example, the following appears in a business trial balance at the end of the financial year, at December 31, 2018. You have the list of expenses and other incomes. And we are then told that at the end of the year, the additional information is then given. Part A, we need to calculate the amounts to be charged to the income statement at the end of that particular year. The solution. The electricity charges are going to be written under expenses. And we have 1,930 that we then paid. But to that, we need to add the $210 that had become due but had not yet been paid. Accruals concept, we're supposed to add because it is accrued in this accounting period. So 1,930 plus 210, we have 2,140 written under operating expenses. We are given interest on loan, and the interest received on loan is actually part of other income. So we then need to remember that the other income is added to the gross profit. So interest received it was 475, yet 110 was still owed to the business. So we then supposed to add the 110. So 475 plus 110, 585. According to the matching accruals concept, it is for this particular period. As much as the business hasn't received any monies, it has to be written in this accounting period. Moving on to the general expenses, we're given 626 that was paid, and then we are told that general expenses included 90 for the following year. So we need to subtract that prepayment. It will be taken into consideration in the year it relates to. We have 716. That will be written under operating or trading expenses. In addition to this, we are then given rent received, which is part of other income and is supposed to be added on to the gross profit. So rent received, 5,420, that is what we had received. But then 240 was received in advance. So that has to be subtracted. We have 5,180. That is supposed to be added onto the gross profit under complementary or other income. So we should note that these two, rent received and interest received for the loan, are part of other income. Added to the gross profit or the gross loss. While the other two are expenses. That should then be deducted from the total income. Right, this was part A. At least for the income statement treatments under the accruals and matching concept. of these expenses and incomes. Right, part B says list the items which should be shown as current assets. So we go to part B, current assets. In the statement of financial position will include, obviously, after stock and trade receivables, should include the interest income owed to the business, $110, and then the general expenses paid in advance, of how much? $90. We then need to understand that these two are part of what we call other receivables. And let me reiterate that any income owed to the business or is accrued to the business but hasn't been received is then considered to be a current asset, because the individual or business that still owes those amounts, those incomes, are more like debtors. So part C, the items that should be shown as current liabilities in the statement of financial position we have electricity charges of 210 that are due but not paid. So we still owe the individual, the electricity supply authority there of 210. That's a current liability. Another one, the rent received in advance becomes a liability because now we owe them. And that in itself is a current liability. $240. And we should then bear in mind that these two are considered to be part of what we call other payables in the statement of financial position. So this is how we're supposed to then apply the accruals matching concept, although the questions may be slightly varied from what we have it's pretty much how we apply the particular concept.